Here is the question every Canadian has had, and almost nobody gives a straight answer to. If you had $300,000, should you put it into the stock market or Canadian real estate? Both camps have passionate defenders. The real estate crowd points to tax-free principal residence gains, the ability to use leverage, and Canada's decades-long housing appreciation. The stocks crowd points to lower barriers to entry, global diversification, and compound returns that require no tenants, no maintenance, and no mortgage. Here is what the data actually says. From 1996 to 2020, according to RBC Global Asset Management data, the S&P/TSX Composite Total Return Index produced 8.0% annually, while the Canadian National Average Real Estate Return was 5.7% annually, without leverage. A $300,000 investment in the TSX over that 25-year period, approximately $2,037,735. The same $300,000 in average Canadian real estate, approximately $1,195,888. Without leverage, stocks won by approximately $841,847 over 25 years on the same starting capital. But add leverage, a mortgage on the real estate, and the picture changes dramatically. Because you can buy a $1.5 million property with $300,000 down. The entire $1.5 million appreciates. Your return is calculated on the property value, not just your down payment. That leverage can make real estate's total dollar return dwarf the unleveraged stock portfolio. So which one is actually better? The honest answer is, it depends on 5 specific variables. And this video works through every one of them, with the 2026 data that makes the answer concrete for any Canadian. Let's start with the most important data: what each asset class has actually returned over long periods, before leverage, before tax, before costs. Stock market returns, Canada and global. The S&P/TSX Composite Index delivered an average annualized return of approximately 7.9% over 34 years from 1990 to 2024, including both capital appreciation and dividends reinvested. According to Coldwell Banker Horizon Realty's 2024 historical analysis, the S&P 500, in Canadian dollar terms, produced an even more impressive 15.73% annualized over the 10 years to December 31, 2022, according to Globe and Mail data. The U.S. market's technology-driven growth amplified Canadian investors' returns significantly over this period. The long-run global stock market average, across all countries and all periods, sits at approximately 7% to 10% annually, depending on the time period and geography measured. Canadian real estate returns. The national average Canadian house price appreciated at approximately 6.8% annualized over the 10 years to December 31, 2022, according to CREA data cited by the Globe and Mail. Over the longer 34-year period from 1990 to 2024, Canadian real estate produced substantial gains nationally. The national average house price grew from approximately $152,000 in 1990 to over $700,000 in 2024, an annualized gain of approximately 4.5% to 5.5% in price appreciation alone. The Academic Long-Run View, a landmark study covering 145 years of global returns, found that including both price appreciation and rental income, the annual return on global housing was 7.05% compared to 6.89% in equities. At first glance, nearly equal over the very long run. But this comparison includes rental income in the real estate return. For an owner-occupied principal residence, there is no rental income. The appreciation-only return on housing is substantially lower than the total equity market return over comparable periods. The 2026 snapshot. In the year to June 1st, 2026, the S&P/TSX Composite was up 31.63% year-over-year, while the national MLS Home Price Index was down 4.7% year-over-year. This one-year snapshot dramatically favored stocks, driven by Canada's post-tariff market recovery and the technology-led global equity rally. The honest summary: over most long-run periods in Canada, stocks have produced higher raw returns than real estate when measured without leverage. The gap narrows significantly when rental income is included in the real estate return. And leverage, which we cover next, can flip the outcome entirely. Your action step: look up the actual performance of both asset classes over the last 10, 20, and 30 years using the TerraNet House Price Index for real estate and the TSX Total Return Index for stocks. Compare them side by side for your specific region, because local real estate performance varies dramatically from the national average. Here is the single most important concept in the stocks versus real estate debate, and the one that makes every simple comparison misleading. Real estate can be purchased with leverage. Stocks, for most retail investors, cannot. When you buy a $700,000 home with a $140,000 down payment, 20%, you control a $700,000 asset with only $140,000 of your own capital. If the property appreciates 5% in 1 year, it is worth $735,000. Your $35,000 gain represents a 25% return on your $140,000 down payment. Not 5%. That is leverage at work. And it is why the direct return comparison between stocks and real estate is fundamentally not apples to apples. Let's run the full leverage comparison. Leveraged real estate at $300,000 down on a $1.5 million property. At 5.7% annual appreciation, property value, after 25 years, at 5.7%, approximately $5,977,000. Original investment, $300,000 down payment plus mortgage payments. Gross equity, approximately $5,977,000 minus remaining mortgage. Return on $300,000 initial capital, dramatically higher than the unleveraged comparison. The leverage amplifies both gains and losses. When Canadian real estate was appreciating 10% to 20% annually in 2021, leveraged property investors captured those returns on the full property value, not just their down payment. When prices fell 20% in 2022, those same leveraged investors saw their equity compress significantly. The important caveats: leverage is not free. The mortgage carries interest at a 4.14% rate on $1.2 million. The annual interest cost alone is approximately $49,680. Over 25 years, total interest paid approaches $400,000 to $600,000 depending on rates. Property taxes, maintenance, typically 1% of value annually, insurance and transaction costs, realtor fees of 5%, land transfer tax, add further costs that directly reduce the leveraged return. When all carrying costs are netted against the leveraged appreciation, the actual net return on leveraged real estate is substantially lower than the gross leverage calculation suggests. The margin account comparison. For completeness, stocks can also be purchased on margin. But margin investing for retail Canadians carries higher interest rates, forced margin calls if the market falls, and substantially higher risk than a mortgage-backed real estate purchase. Most financial advisors do not recommend margin investing for retail investors, making the leverage comparison genuinely asymmetric. The practical conclusion on leverage: for a Canadian who qualifies for a mortgage and can sustain the carrying costs, leveraged real estate can produce wealth outcomes that unleveraged stock investing cannot match in absolute dollar terms. The return on down payment capital in a rising market is uniquely powerful, but the carrying costs, time commitment, and concentration risk are real and must be fully accounted for. Your action step: if you are comparing real estate versus stocks, calculate both on an equivalent capital basis. What return does your $140,000 down payment earn in stocks versus in real estate? Include all real estate costs: mortgage interest, property tax, maintenance, insurance, transaction costs. The comparison is only meaningful when it is honest. Here is where the comparison tilts definitively in stocks' favor for most Canadian investors, and it is an advantage that is uniquely powerful in Canada. Real estate tax treatment. Your principal residence, the home you live in, can be sold completely tax-free under the principal residence exemption. No capital gains tax on the full appreciation. If you bought a Toronto condo for $500,000 in 2015 and sold it for $900,000 in 2025, the $400,000 gain is completely tax-free. This is a genuinely enormous advantage. For owner-occupied real estate, the tax treatment is exceptional. For investment properties, rental properties that are not your principal residence, capital gains are taxable at the 50% inclusion rate. If you sell a rental property for $300,000 more than you paid, $150,000 is added to your taxable income and taxed at your marginal rate. Rental income itself is fully taxable as employment income, taxed at your full marginal rate with no preferential treatment. Stock market tax treatment. Outside a TFSA or RRSP, stock market gains are taxed as capital gains at the 50% inclusion rate. Dividends from Canadian companies receive the dividend tax credit, taxed at a significantly lower rate than employment income. But inside a TFSA, stock market gains, dividends, and interest are all completely tax-free. The TFSA is the most tax-efficient investment vehicle available to Canadian retail investors. The critical comparison: owner-occupied real estate, tax-free gains, principal residence exemption. TFSA stocks, tax-free gains. Both are tax-free. On this dimension, they are equal for most retail investors. But the TFSA has an annual contribution limit of $7,000, while the principal residence exemption is unlimited. A $2 million gain on a Toronto home is completely tax-free. A $2 million gain inside a TFSA requires decades of contributions to accumulate that much invested capital. For most Canadians with limited capital, the TFSA's $7,000 annual limit means that the principal residence exemption provides tax-free treatment on substantially more capital than the TFSA can shelter. For rental properties versus TFSA stocks, the TFSA wins clearly. Rental income is fully taxable. Rental property capital gains at 50% inclusion rate. TFSA gains at 0%. For the investor choosing between rental real estate and TFSA stocks, the tax treatment decisively favors the TFSA. Your action step: identify every investment you hold outside a TFSA or RRSP. Calculate the annual tax cost, dividends taxed at your marginal rate, Interest taxed at your marginal rate. Compare that to the cost of moving those holdings inside your TFSA. The tax saving is often significant and immediate. Beyond raw returns and tax treatment, four practical factors dramatically affect the real-world outcome of each asset class. Most comparison articles ignore them. This one doesn't. Factor 1. Liquidity. Stocks win decisively on liquidity. Your TFSA invested in XEQT can be liquidated in minutes during market hours. No realtor, no closing timeline, no buyer dependent on mortgage approval, no 30 to 90-day close period. Real estate is fundamentally illiquid. In a normal market, selling a property takes 30 to 60 days from listing to close. In a slow market, much longer. If you need $50,000 for an emergency, you cannot sell 5% of your house. You must either refinance, take a HELOC, or sell the entire property. This illiquidity is not always a disadvantage. The difficulty of selling a property acts as a behavioral constraint, preventing the panic selling that destroys most retail investors' stock returns. Most homeowners stay invested through market downturns simply because selling is difficult. Most stock investors sell during crashes because it is easy. Factor 2. Diversification. Stocks, particularly through a globally diversified ETF like XEQT, give you ownership of approximately 9,000 companies across 50-plus countries. No single company, industry, or geography can permanently destroy your portfolio. Real estate is inherently concentrated. A Toronto condo is 100% exposed to Toronto price dynamics, the specific building's condition and management, the specific tenant's reliability, Toronto employment, and Ontario policy decisions. The concentration risk of a single property investment is substantially higher than a globally diversified equity portfolio. Yet most Canadians hold the majority of their wealth in a single piece of real estate. Factor 3. Time and management. Stocks require no active management after purchase. DRIP enabled. Monthly contribution automated. Zero ongoing time commitment. A rental property is an active income source. Tenant screening, maintenance requests, vacancy management, annual tax filing, insurance renewal, property management fees if outsourced. Even with a property manager, a rental property requires ongoing attention and decision-making that a stock portfolio does not. The hourly rate of a landlord's time, when allocated across all management activities and divided by the net annual cash flow, is often surprisingly low. Factor 4. Minimum investment. You can invest in XEQT for as little as $1 at Wealthsimple, with no minimum. You can build a diversified global equity portfolio for $500 per month with no debt, no qualification process, and no credit check. The minimum investment in real estate in Toronto is approximately $207,400. The 20% down payment on a $1,037,000 average home, plus $56,449 in closing costs. Total cash required before moving in, approximately $264,000. For a 27-year-old Canadian earning $70,000, accessing real estate requires years of saving just to reach the starting line. Accessing the stock market requires an afternoon and $500. Your action step: rate each factor: liquidity, diversification, time requirement, minimum investment, in order of personal importance. The factor you weight highest will likely determine which asset class is right for your specific situation. Here it is. The honest answer, delivered for 5 specific types of Canadian investors, rather than as a single universal declaration. Investor Type 1. Young Canadian under 35 with limited capital. If you have $500 to $2,000 per month available and cannot yet accumulate a down payment, stocks win. Open a TFSA. Buy XEQT. Automate. The compound growth on a $500 per month investment over 30 years at 8% builds $745,179. Tax-free. Real estate is not accessible until the down payment is saved. Stocks are accessible today. Investor Type 2. Canadian with $80,000 to $120,000 saved and good income. You have a realistic down payment in many Canadian markets. The decision now depends on your local market's price-to-rent ratio and your personal circumstances. If you are buying a primary residence, you will occupy. The principal residence exemption makes real estate highly tax-efficient, and you get the use of the property. If you are buying an investment property, the tax treatment of rental income and the time commitment make the TFSA a serious competitor. Investor Type 3. Homeowner who already has a primary residence. You already have leveraged real estate exposure. Adding more real estate concentration increases your risk. The optimal move for most established homeowners is to build the TFSA and RRSP asset column, diversifying away from the concentrated real estate position that already dominates the balance sheet. Investor Type 4. High-income professional at $150,000 plus. At high income levels, the rental income tax disadvantage is most punishing, 43% plus marginal rate. The RRSP and TFSA provide tax shelter that rental real estate cannot match. The optimal strategy typically prioritizes RRSP, immediate marginal rate saving, plus TFSA, tax-free growth, before rental real estate. Investor Type 5. Real estate-focused investor with capital and time. For investors who have the capital for a significant down payment, the time to manage properties actively, comfort with leverage and concentration risk, and access to markets with strong rental yield, real estate can produce exceptional leveraged returns that stocks cannot replicate without margin. The caveat: this is an active business, not a passive investment. The single most honest statement about stocks versus real estate in Canada. Most Canadians should own their primary residence and maintain a growing TFSA invested in diversified equities. The two are not competing choices. They are complementary parts of a balanced wealth strategy. The real estate provides leveraged appreciation, tax-free principal residence gains, and a place to live. The TFSA provides liquid, diversified, tax-free investment returns that the real estate cannot provide. The question is not stocks or real estate. The question is in what order and proportion, based on your income, capital, time horizon, risk tolerance, and local market conditions. Let's come back to where we started. $300,000 invested in the TSX over 25 years without leverage, approximately $2,037,735. $300,000 invested in Canadian real estate over 25 years without leverage, approximately $1,195,888. Without leverage, stocks won by $841,847 over 25 years. But with a $300,000 down payment on a $1.5 million property, the leveraged equity outcome can dramatically exceed the unleveraged stock comparison. The leverage is real. The carrying costs are also real. The net outcome depends on the specific market, the specific property, the specific rate environment, and the specific time period. The tax treatment of primary residence gains, tax-free and exceptional. The tax treatment of TFSA gains, also tax-free. The tax treatment of rental income, fully taxed at your marginal rate. And the TFSA wins decisively. On liquidity, diversification, time requirement, and minimum investment, stocks win on every dimension. The honest answer? Stocks are the superior investment vehicle for most Canadian investors, especially when held inside a TFSA, on the basis of raw returns, tax efficiency for rental income, liquidity, diversification, and accessibility. Real estate, specifically an owner-occupied primary residence, adds the unique advantages of leverage, unlimited tax-free capital gains, and the behavioral discipline of illiquidity. The optimal Canadian wealth strategy for most earners: own a primary residence and max a TFSA invested in a low-cost global ETF. Both, in that order or simultaneously, depending on your income, capital, and local market. The debate is not stocks versus real estate. The debate is how much of each, and in what sequence.